Hello everyone and welcome back to the sessions on CFA level 1 in continuation of the topic financial statement analysis, within which now we are going to discuss one very important aspect, that is analyzing income statement. So if you can recollect what we have learned in the earlier classes, income statement can be classified into two components. One is what we call as profit and loss statement, and another could be the statement of other comprehensive income. So profit and loss statement and other comprehensive income taken together will constitute to total comprehensive income. Now income statement, as you would have generally understood, making a profit and loss statement, you identify all the components of your income, all the components of your expenses, you accommodate two more aspects, that will be gains and losses in your business, and the final result will be the amount of profit that you would have earned. So the profit that we obtain from the revenue statement or income statement will be the profit before taxes. Then how to deal with income taxes will be another area of our discussion, and then from the amount of profit before tax, when you subtract the amount of tax expenses for the period, you will end up at the amount of profit after tax. So everything that will be part of analyzing the whole income statement will be the subject matter of discussion over here. And the first thing that we need to get started over here in terms of analyzing income statement is to deal with revenues, and most important thing, revenue recognition. So guys, basically what we need to understand, if you can see this title, it comprises of two words. One is revenue and one is recognition. So what is the meaning of revenue? As generally understood, revenue itself means your income. The word recognition is in your accounting records. When will you pass an entry for revenue? When will you recognize, means when will you record a revenue? So the fundamental principle of revenue recognition is the earning of income. So here I want you to clearly understand, there is a incidence of receiving money out of the revenue that you have generated, and there would be an incidence of recognition of income, and both of these are two different incidences. Sometimes it may happen that both of these events occur together. For example, I am selling a product, any product, say calculator, a pen, a notebook. I am a stationery store owner and you visit my stationery store to buy a pen. You give me, say, an amount of $10 to buy that exclusive pen, and for $10 I have sold you that pen. Now that pen I have sold to you and you have given money. Once this transaction is done, it is complete transaction where on the spot I will recognize the revenue, means I will record my income arising from sale of goods. So basically any entity, how do you think they would be generating income? There may be two primary sources of generating revenue. One is sale of goods and another is provision of services. Right now what I am doing for you, I am providing my services to you and I am generating revenue out of that. Let us try to go little deeper into those two events that I was talking about. So, you know, the criteria to take my services is to pay the amount upfront, then only I provide you the video access to my classes. So you have given me the amount. As soon as you have taken this product, you have already paid the entire amount of fees. But this entire course duration will take, say, 4 to 6 months time, where gradually over a period I will be providing this service to you, and gradually over that period I should recognize my revenue out of that. That means revenue recognition is completely dependent on the fact when do I earn that income, and the customer or the client paying me the amount of cash towards that purchase or acceptance of services provided by me could be the two different incidences, and we should be clearly demarking the two. Many a times what may happen, for example, I own a big electronic store. You visit my store for purchasing a television. Now you have selected a nice piece of television, and what is the condition? You pay the amount. You don't have to carry the television with you. My engineer would come at your place, will deliver the product, install the product, explain you the functionality and features of that product, and once you are satisfied that installation is complete, you will sign a document. As a customer, you will sign a document mentioning that the installation and delivery, or rather I would say the delivery and installation of the product has been up to your utmost satisfaction and you are happy with what has happened. And once you sign that document, that completes my performance obligation. Only on completion of my performance obligation, I will consider that sale has happened. So if today was the day when the television was installed at your place, then today I can recognize the revenue. But say 5 days prior to this day, you have already given me the money. So money was received, but the obligation that I had to perform was not complete for me to identify the event of sale. See, sale is an event where there has to be transfer of goods and services, and where all the necessary activities pertaining to the sale, like for example, delivery and installation in this example, were part and parcel of that sale event. Once the whole activity set is complete, then and then only I can say that as a seller, as a supplier, my obligation is over. This is what we call as performance obligation. So the happening or the occurrence of performance obligation is required before the revenue is recognized. So we have to establish a general principle that revenue should be recognized when the income is earned. Now you know one thing, right from the beginning in accounting, if at all you have started learning accounting little earlier, and you have been from commerce background, or you have at least learned a bit of accounting, there is something called accrual basis. What is accrual basis? Accrual basis is a basis in accounting where you wait for the income to be earned, not just receive the income. You wait for the income to be earned, and then you recognize that income, then you recognize that revenue. So as I said, the general principle with respect to revenue recognition is emphasizing on one thing, that you need to earn your income to recognize that income. Your receipt of that income has nothing to do with earning of that income. Earning of that income can have its own criteria for recognition, and that is what we are going to talk in detail when it comes to revenue recognition. Now what happens? See, there are lots of aspects in this modern business world where you need to understand that revenue recognition can sometimes be little tricky, and that is where you need to understand why we are learning so much about revenue recognition. I'll give you one simplest example, and I'm sure you'll be able to relate this. Suppose I have a big garment store and you are my customer, and our store has a policy of offering reward points to the customers every time the customer comes and makes a purchase. Every time the customer comes and makes purchase, we provide reward points to the customer. So a customer will be given a card, and on punching that card, electronically those reward points get added to your card. Then these reward points contain some monetary value. Throughout the year, you kept on purchasing products from my store. One fine point, you have accumulated good chunk of points. One fine day, say maybe on your birthday, you come with your card and you want to redeem your reward points. When you redeem your reward points, that day precisely you did not pay me any money. You have purchased the merchandise from my store that day only to the extent of reward points accumulated by you. That day you did not pay me a single dollar amount, not a single penny you have paid, but you have purchased good quantity of merchandise on that day as well. So practically that day also I have made a sale. That day I have received no money, but I have to recognize revenue arising on that event of sale even on that day. But that money you have already paid me earlier. So can you understand to what level we are trying to touch this aspect of revenue recognition, and there may be real life complications involved over here. That is why fundamentally it is very, very important to understand why revenue recognition has to be given so much importance. So first thing that I want you to get into your mind very clear, drill it into your mind, that the aspect of earning income and aspect of receiving money are two different things. We are not supposed to club these two unless coincidentally the two events happen together. And absolutely on cash basis, when you are receiving that cash is definitely not important. When you are earning that income is the only important factor. And that is where we come up with the principles of revenue recognition. So as I said, let me give you some important notes over here. Please pay attention on the screen. As a general rule, revenue is recognized in the period in which it is earned, which may not necessarily be the same as the period in which the cash is collected from the customer. The recognition of revenue is not, however, dependent on receiving cash payment. If sale of goods is made on credit, there may be a pattern of making sales of goods on credit. So you buy the goods now, you may make the payment after 1 month. That is the discount or credit policy that I am offering to my customer. And if the customer makes the payment within 7 days, then I may offer some cash discount, something like that. But sale has happened today and customer is supposed to pay after a month's time. In that case, the incidence of payment should not stop me from recognition of revenue. That is why what is written over here, if you pay attention, if a sale of goods is made on credit, revenue can be recognized at the time of sale and the asset. So parallelly what I'll do, against a sales or revenue recognition on sales, I will create an asset that will be a debtor or accounts receivable in my balance sheet, is created on the balance sheet. Accounts receivable arises in the balance sheet. Inversely, imagine the other way situation. If the payment for the goods is received before the transfer of goods, a liability in the form of unearned revenue or an advance receipt, that liability is created. So you understand one thing, if money comes later but sale has happened earlier, against the sale an asset will be recognized. When money has come first and sale has not happened, it is to be treated as an advance receipt and not the revenue, and therefore it is a liability upon me. To get rid of that liability, to extinguish that liability from my balance sheet, I have to either give you back that money or I have to provide you the goods that I have promised. So I would want you to take note of these important points, and then I take you ahead. Alright friends, I am sure you have completed writing these points. Let us talk further. Now see, developing a good level of understanding in this topic is very, very important. So I don't want you to have a shallow understanding. I want you to have in-depth understanding. And keep in mind one thing, like any other subject at your CFA level 1, financial statement analysis is also a crucial subject where it not only helps you pass your level 1 exam, but it creates a very strong foundation for understanding FSA at level 2 as well. So please carefully understand this and take your understanding as deeper as you can. So coming back to our point about revenue recognition. So guys, You know, just imagine, initially I gave you example of a pen that I'm selling you, that is selling to my customer for $10. What is happening over there? Pen is delivered, customer paid $10 already, and now return is not allowed. There is no warranty, there is no guarantee, there is no further discount offering, nothing. In that case, keep in mind one thing, the incidence of receiving money from the customer and the incidence of sale happening are happening as if it's one singular event. But we should always identify these as two different events, just that the occurrence of both the events happened at the same point of time. And that is the point where you recognize your revenue. However, sometimes sale is made under a warranty. For example, when you bought an electronic product from my electronic store, when you bought a television, the television comes with 1 year warranty. Now, 1 year warranty means anything happening to that television within this 1 year from the date of sale, the customer has right to get it repaired, correct, either from the manufacturer or from the dealer, depending upon what is the condition under warranty. But ultimately, because I am a dealer of the product, I am the seller of the product, the question is, until that warranty period expires, can I recognize the entire revenue on sale? Let me answer this question. As per the requirements of US GAAPs and IFRS that follow very practical approach, what is stated is, on a case of warranty, you recognize your entire revenue from sale. However, based on your past experiences, you might come to know that what would be a general amount of outflow that may occur for every $1,000 of sales, for example. And based on that, you create a provision for those warranties. Similar kind of provision may be created for discounts to customers. For example, I am making a credit sale. Okay, I am making a credit sale. The invoice value is say $100. Condition is what? If you make the payment within 7 days, then $2 discount will be given to you. You have to then pay only $98. In that case, whether you will make the payment within 7 days and avail the discount from me, or whether you will make the full payment and you will take entire 1 month credit from me, it depends on your action as a customer. And for me, it is uncertain, right? But past is a biggest indicator of what can happen in future. So general pattern of what has been the level of discount expenses in the past, suppose I find that 20% of customers generally pay within 7 days time. So whatever sale I am making in this month, 20% of that sale, on that 2% discount provision I will make as a liability. I'll make a provision against that revenue. So revenue recognition is complete, but I'm creating a provision for offering or allowing that cash discount to my customers. So various things that you need to understand are all given under all the converged standards under IFRS. So you know, IFRS standing for International Financial Reporting Standards. We have talked about this in earlier classes, and the generally accepted accounting principles that are in the US based application, that is entities operating in the US, will be following the US GAAPs. So what is the requirement of IFRS as well as US GAAP? Generally they would be having similar approach, but there may be differences, and that is where you need to even understand at all the required points what is the difference between the recognition aspects under both the set of standards. So let us write some additional notes over here. Please focus on this point further, what we have discussed. In a sale of goods where the goods or services are exchanged for cash and returns are not allowed, the recognition of revenue is straightforward. It is recognized at the time of exchange. Revenue is reported net of any returns and allowances in the income statement. For example, estimated warranty provision and customer discounts. Converged standards under IFRS and US GAAP take principle based approach to recognition issues, that is revenue recognition issues. The central principle is that firm should recognize revenue when it has transferred a good or service to a customer. Now that is a common requirement under IFRS as well as US GAAP. So please write up these important points and then I take you ahead. Alright friends, once you have completed writing this much, let me give the required explanation further. So worldwide, in order to bring complete harmony in the financial reporting, it is recommended that all the companies across the world should follow either the IFRS or the converged form of IFRS. And that is why even in the US, it is an attempt that is made to bring as much closeness in reporting, which could be earlier observed as a significant difference between IFRS and US GAAPs. The gap over there, GAAP is what I am talking about. The gap between the reporting, the differences in reporting is attempted to reduce or almost eliminate with the basic core objective of bringing harmony in reporting by entities across the world. And that is why in all the countries, either IFRS are implemented as it is, or the accounting bodies in that country, they are converging these standards in their own way to match the reporting exactly in accordance with IFRS. So when we are talking about IFRS with respect to revenue recognition, you should be aware that IFRS 15 is the standard on revenue recognition. And this standard has come up with a 5-step model. That means if you need to understand the standard in its entirety with depth of understanding, you need to understand these 5 steps in the right sequence, and practically you can deal with any situation of revenue recognition. So I don't want you to create an example based learning that okay, in this example we should create the revenue recognition criteria this way, okay, in this example it is this way, in this. See, examples should be in support of your core understanding. Examples cannot be the base of learning. Examples should help you to understand things better, but the core principle is what you need to first understand. So before I enter into that 5-step model, let me highlight some important aspects about IFRS 15. So IFRS 15 is based on a core principle that requires an entity to recognize revenue in a manner that depicts transfer of goods or services to customer. So there has to be transfer of goods or services to customer. That is one condition. And at what amount? At an amount that reflects the consideration. Consideration is basically something in exchange of goods or services that the customer has to pay. So reflects the consideration the entity expects to be entitled to in exchange for those goods or services. I repeat, in exchange for those goods or services. So this is consistent with what? The core principle of revenue recognition, that revenue should be recognized when it is earned. So I'm taking you to the 5-step model immediately after this, but first you quickly take note of these important points. Alright friends, once you have finished writing this content, let me take you ahead and let us understand something about 5-step model. So please write the title 5-step model. Just write this title first, 5-step model, and then I'll explain you the sequence and the content of these 5 steps. So I'm sure you have written the heading 5-step model. So let us talk about this 5-step model. To achieve the core principle. Which core principle? Those 2 points that you have just written prior. Which 2 points? Sale of goods or transfer of goods or service to the customer and the consideration part. So to achieve those core principle aspects, the whole process of revenue recognition is classified into 5 steps. It is rather arranged into 5 sequential steps. So the first step is identify the contract with the customer. See, the first step always begins with identification of the contract with customer. Let me explain something over here. Suppose there is an arrangement between the supplier and customer. So throughout this whole discussion, I will consider myself as the supplier of goods or services, and I'll always consider you as the client or customer. So there is a contract between you and me where I have given you certain goods on approval. I have given you some goods. You can practically, you are allowed to even use those goods and see, are you liking it or not? If you like it, then you confirm within a reasonable time that you want to buy that or you want to return those goods. If you said you don't want to buy the goods, you just return those goods within reasonable time. So there will be a time span given for that, maybe 3 days, 5 days, 7 days, 10 days, where the customer can decide whether those goods will be purchased by the customer or not. So this is what we call as sale on approval. So suppose I have given the customer 1 week time, 7 days time. So from the point of delivery of goods to the customer has 7 days time. So customer can either return the goods or can confirm that the customer is buying the goods within 7 days. If customer has given no response within 7 days, it is implied that customer is buying the goods. So if the customer doesn't want to buy the goods, as per the terms of the contract, customer must either return the goods before 7 days or give a confirmation within 7 days that the customer is not buying the goods. In that case, the supplier will not recognize the sale. So understand one thing, the fundamental aspect always begins with identification of the contract between the supplier and the customer. You need to understand what kind of contract exists between the supplier and customer. Second thing could be to identify performance obligation in the contract. Now what is this performance obligation? So again, taking example of this course that you have purchased from me. If you have purchased this course, what I have to do to complete my side of obligation and what you have to do to complete your side of obligation. So whatever fee that I have prescribed, that you need to pay as a student, as a candidate, that is your obligation. And as per our terms, you have already given that fee in advance. Now, what is to be done? I need to supply to you this service over this time on systematic basis. What if I fail to do so? What if I do not perform my side of obligation? Then what will happen? As a customer, as a client, you will say that I have paid money, but I have not received the services as promised. So either provide me the service or please give me back my money. That means for recognition of that revenue, I cannot recognize the entire revenue even if I have received until I fulfill my performance obligation. So what is my performance obligation? I have to identify as a supplier that what I need to do that will trigger the point where I can identify, where I can assure that goods or services have been transferred. So what is that point of performance? That is an obligation for me. So basically, if someone is earning income, that person has to do something to get that income. Doing that something and specifying what is that thing that you have to do to complete your obligation is involved in the second step. So in the first step, you have identified the contract with the customer. In the second step, you have identified what is your performance obligation. Step 3, determine the transaction price. So what will be the price comes at the third step. Now one thing, it is not just about writing these 5 headings of these 5 steps that the matter will be over. Once you identify what are these 5 steps, then we have to go deeper into each step in detail. Okay, the third step will be to identify what will be the transaction price. Fourth step is the most important step. Now you need to understand this fourth step very well. You know, sometimes it may be a contract where the service provider is taking multiple performance obligations. For example, I am a construction contractor and you are a customer who has approached me, and the customer is asking the contractor to build a house property. Now, the contractor is asking the customer, okay ma'am, please tell me, do you also need the electrification work in your premises? I can do that for you. The customer says, yeah, anyway I want to get it done, you only do it. Okay ma'am, do you want the plumbing work also to be done along with this? Yes. Then customer is being asked that you have a lot of vacant space over here. Can I create a kind of nice decorative garden for you along with a swimming pool over here? Customer says, yes, it will be great. I have plans to do it anyway. Then, do you want me to design the furnishing of the entire property? The internal, the interior designing part, that also I'll get it done. I'll provide you the complete furnished accommodation. In that case, you know what all I'm doing for the customer. I'm constructing the property, I'm creating a decorative garden along with a swimming pool, I'm doing the plumbing work, I'm doing the electrification work, I'm doing the interior designing and furnishing work. Is it a single performance obligation or multiple performance obligation? Now there could be a point of single performance obligation when I promise the customer, I show the customer, this is the property I'll make for you, including everything. A complete property is what I'll do for you. Is that the performance obligation? Or construction work, plumbing work, interior designing work, furnishing work, making the garden and swimming pool, all these are different performance obligation where the supplier or contractor and customer can individually agree or disagree with terms and condition of each obligation. So if there are multiple performance obligation, where did you identify performance obligation? Check step 2. In step 2 you have identified performance obligation. What if it is not a singular performance obligation? Then the transaction price is for the complete job, is for the complete contract. Then that transaction price must be allocated over 5 different performance obligation as identified. So whether there is a singular performance obligation or multiple performance obligation, that you have to identify in the second step itself. That is where when you identify what is the transaction price in the third step, fourth step is asking you, boss, check one thing. Do you have a single performance obligation? In that case, transaction price that is identified in step 3 is completely allocated to that singular performance obligation. In case you have multiple performance obligation identified in step 2, then you better allocate the entire transaction price over these multiple performance obligation. And do you know, before even I mention over here, fifth step is the most logical step, which I'm sure if I ask you to think what it would be, because that is going to be the last step, what it would be, you will also get that click into your mind that once the performance obligation which we have identified in step 2 is complete, then and then only the supplier or the service provider or the goods provider should recognize its revenue. So revenue recognition happens at the end. Revenue recognition on fulfillment of performance obligation, whether it is single performance obligation or multiple performance obligation. Now again over here in fifth step we will understand 2 important aspects, whether the trigger point of revenue recognition is a singular point, that at this point you recognize your revenue, or should the revenue recognition be carried out over a period of time. So whether it is over a period of time or it is a singular point, that also has to be identified in the fifth step, and that makes your entire process of revenue recognition complete. As I said, don't consider that this topic is over with these 5-step headings. These are just the headings. We will be discussing all these steps in details once you write up these 5 steps quickly.